All right, good morning, everyone. All right, we've only got 20 minutes, and I got a ton of slides to go through. So even though I'm from the South and I have a little bit of a Southern drawl, we're going to go quick through here and leave some time for questions with everyone. So let's get started. Whenever we want to look at what we think is going to happen going forward in the markets, we always stop and take a look back. And where have we come from? Why are we sitting in the situation that we are? So here's just a quick chart to show you some returns, both from the second quarter of this year and then for the full 6 months. I want to draw your attention to the middle of the chart. You see the S&P 500 total return index up 10% in the second quarter. So we know in the first quarter we had the start of the drawdown. We really saw that reverse in the second quarter. You also see a lot of positive movement when it comes to what we call the rest of the world. Look at the MSCI that's there outside of the US. We're getting strong returns for both the quarter and the year. And then if you take a look down towards the bottom, gold and Bitcoin obviously had a tremendous second quarter with a lot of anticipation of some new bills that might get passed. I think they're going to be voting on that again today. It did not pass yesterday, but I think they have the votes today. And gold, obviously, in the first 6 months, most of that in the first quarter, up almost 26%. So really kind of a risk-on feeling in the markets for the first half of the year following the initial pull down. Now, when we start looking at how we want to invest, we really kind of build everything on a few premises. And I want to go through those premises with you so you get an idea of kind of where our head is at when we're looking at investing. So this is what we were thinking coming into the year. US was going to remain the global growth engine. Well, we just saw the rest of the world actually picked up and did a little bit better. Business cycle would continue to expand, probably supported by the consumer. One of my favorite things to say, and I heard it years and years ago, is that the US consumer likes to spend when they're happy, and they like to spend even more when they're sad. So it's just kind of, the consumer has this underlying support system going there. We figured the Fed would lower rates. Our base case all year has been 2 rate cuts in the second half of the year. It seems like that's kind of where we're headed, probably September and December. We'll see what happens with some of the numbers between now and the September meeting. I mean, we do have the July meeting, but I think most people think that will be kind of a pass on the July meeting. AI would continue to drive things, a more favorable regulatory backdrop. We actually thought we would see earlier in the year than what we have seen. We thought that would bring a little more positive news earlier in the year. Earnings growth would broaden. It's not just going to be the Mag 7. I mean, how many people are tired of hearing that phrase? Me, for one. We really wanted to see that broaden out. We thought there would be considerable uncertainties. Well, if that's not the understatement of the year, then I don't know what is, but heading into 2025, we were saying there would be considerable uncertainties. Equity valuation levels were very high, and we were concerned about that coming into the year. We'll talk about that in a little bit. Higher volatility and dispersion would probably happen, an attempt, I should say, at a renovation of the federal government and an America First foreign policy. So this is kind of how we framed our decision making as we came in to 2025. But the problem was there was this super high bar that the market had set coming into this year. Valuations were really high. There were high earnings expectations, double-digit earnings growth for every quarter of this year. There were high growth GDP expectations. I mean, there were some analysts that were out there saying we would get 5-6% GDP growth in some of these quarters. So there appeared to be like this very hardy kind of set of obstacles that we were going to have to get across at the same time that uncertainty was continuing to build. You know, there's a few points here. Growth expectations were higher this year than the last 2 years when we had over 20% returns in the equity markets. So there were a lot of high expectations coming into the year. That made us a little bit nervous. But what have we actually seen here happening in the second quarter? We can have our premises, we can, talk about what we thought coming into the year, but what actually happened over the last 3 months? Well, we know early in the second quarter, following, our Liberation Day, the S&P completed a 20% decline from the February high. It was actually interesting. I was in New York meeting with some clients right before the Trump had his meeting about the tariffs, where remember he had like the chart and all that kind of stuff. So the taxi dropped me off in front of the hotel. I'm watching on my phone, markets are fine, nothing's really happening. From the time that it took me to get out of the taxi cab, up the elevator to my room, I turned on the TV and I was like, what in the world just happened? I missed like 5 minutes and everything went crazy. And so we saw those big declines coming in. The uncertainty index, which if you don't follow that, I would suggest follow the uncertainty index. It really gives you a little bit of a heads up on kind of what volatility you can expect in the equity markets. The uncertainty index was skyrocketing in the early part of the second quarter. But then as we went through the quarter, what happens? Well, S&P rocketed 20% higher, recouped almost the entire correction at the time that this slide was made. Now we have actually recouped that. I do think it's interesting, if you look at this slide, it was the fastest return in history to a new high, following a 15% drawdown. You can see all the different times there, the different years. An average of around 36 days is what we had there. But 55 trading days back to the high, or 361 days, sorry. 55 trading days is all it took us to get back to the highs. Let's see, if we go back to our observations, the recession probability. If you had talked to me earlier in the year, I would have told you I thought we could have a mild recession. That was baked into our probabilities. That's really diminished now for multiple reasons. I think people have kind of backed off a little bit of their concerns as to how high tariffs might actually turn out to be, that there's some waffling going on in there. I think that people think the consumer will be stronger than maybe what they anticipated earlier in the year. So recession probability has come down. A lot of that too because for corporations, their margins have been so high that they're able to take a little bit more pain this year. Earnings expectations fell, but only modestly. We actually thought we would see them fall a little bit more than what they did. And a few of the Mag 7 and some of the other growth names started to come back in the second quarter. We were seeing some sector rotation, and we'll talk about that in just a minute. So what's really driving all of this action that we had? Well, there's a lot of factors, really, that you need to consider. And I want to take a couple minutes on this slide and kind of go through each of these, because these are all the elements I watch on a daily basis to try to help me decide how to invest our clients' money. Consumer sentiment. There is this divide right now between behavior that we see from consumers and the price action in the market. Typically, when you see a market reaching new highs like we are right now, consumer sentiment is moving up tremendously. And we're not seeing that. Is it up a little bit from where it was a month and a half, maybe 8 weeks ago? Yes, but it's still not at the level that it should be for a market that's making new highs. So we need to kind of watch consumer sentiment and see if it improves or if it really starts to stagnate. Obviously, inflation is something we've all been watching. Consumer inflation, the CPI yesterday, we all heard about what happened there, a little bit hotter than expected in some of those elements. It was mostly in the goods sector where we were seeing some of that hotter than expected inflation. You look at things like furniture, appliances, toys, sports equipment, things like that, saw pretty significant increases in prices, while services actually continued to come down a little bit. So maybe that's the beginning of some of the, what we might call tariff inflation, starting to seep through. But then we got PPI this morning unchanged. And if you watched the market this morning, as soon as the numbers came out, I was watching on CNBC, and you know, Rick Santelli gets so excited. It's quite entertaining to watch him announce these numbers. It was unchanged, and the market rallied, yields came down, and then all of a sudden he says, wait a minute, there's pretty significant revisions to last month. So last month's numbers were bumped up by about 0.3%, which is kind of what they expected to see this time. So it kind of came out in the wash between the revisions and what we were there, and we saw the market reaction start to pull back a little bit. And we have to think, these are June numbers. Are we not seeing producer prices move higher because they already bought their inventory previously? All of the pull forward that we've talked about prior to tariffs being implemented. Because if you look at July ISM numbers, they actually show prices paid increasing pretty significantly. So I'm concerned that the PPI might give us a little bit of a head fake next month. So let's watch that. University of Michigan inflation expectations, it's those longer term inflation expectations that the Fed is worried about, that becoming unanchored. I think we're okay there. There's liquidity movement. With the debt ceiling debate, and I don't want to get too technical, but the Treasury then has to take money from their general account and dump it into the economy until that debt ceiling got raised. That added liquidity to the market and pushed yields down. Now that the debt ceiling has been raised, that liquidity is going to come out of the market, and it could be a reason we've seen yields move back up towards that 4.5%. Market leadership is starting to change, so we want to watch that. Some sector rotations. We've seen tech come back into favor. We've seen industrials and financials continue to lead. Cyclicals are starting to pick up a little bit, so we watch all of that. Obviously, policy uncertainty and the weakness in the labor market. We'll touch on this in a minute, but I do want to say, I know a lot of people say the labor market's doing just fine, and they're watching that non-farm payrolls number that comes out the first Friday of every month. But look at the JOLTS number and kind of look under the hood a little bit, and what are we seeing? Low hiring, the time of unemployment, if someone's unemployed, is increasing. Continuing claims are moving higher. Cyclical job growth, which is what really drives more and more jobs, is actually declining. We're having more part-time workers come in, and the challenger layoffs are moving up ever so slightly. So it's not, I don't know how many of you used to watch The Price is Right, it's been years, but do you remember that game where you had the man like yodeling and he'd go up the little hill, and if your price was too high, he'd fall off the cliff? I love that game. We're not going off the cliff. We're not yodeling and going over the cliff. But are we getting to a point that I think we need to pay a little bit more attention and be concerned about it? Yes, I think we are. So lots of data to analyze. And you've probably heard the debate around soft data and hard data. It kind of goes into two different things, surveys versus, actually hard data where we're getting reporting. Soft data has been weak. Hard data was holding on. Soft data usually leads hard data, right? Soft data is kind of the expectation of what you think is going to happen. Hard data is more the confirmation of that expectation. And for sure, we have seen hard data start to weaken. Housing has been weakening. Manufacturing has been weakening. Continuing claims, like I mentioned a moment ago, are continuing to move higher. So all of this has led our team to have really a cautious view. And I hate to be the Debbie Downer at the party, but I'm afraid I'm going to be just a little bit here. We are cautious for the rest of this year. Not that we don't think there are tailwinds that can help this economy continue to move higher, but we think you need to be cautious as to where you're investing. We want you to put your money to work, but let's be a little bit careful with it. And there's three reasons we're being cautious. One, we think consumption is slowing. Again, not collapsing, we're not yodeling over the cliff, but we do think that we need to be a little bit more careful, and some of that is because of what I just mentioned. We think the labor market is softening. The two are combined, or they're dependent on each other. The consumers will crack when the labor market cracks. And the consumer has actually been holding up pretty well. Why? Well, wealth effect, equities have been doing okay once we got past that initial drawdown. Labor market is not collapsing, right? It's weakening, but it's not collapsing. Wage growth is respectable, although we are seeing that start to come down. Inflation so far has been tolerable, and we do think that this was done before the bill just passed, the reconciliation bill, but stimulative tax bill would be coming, part of that reconciliation bill. But again, labor stats are weakening, so we need to pay attention to that. And when labor weakens and the consumer stops spending, then earnings growth comes under pressure. Look at the estimates that we had for 2025, and then look at the beginning of the year, and then look where we are as of June 15th. Those have come down pretty significantly for a lot of different sectors. And so when earnings expectations come down, that makes us concerned about kind of that whole, it's like setting up a big domino event, right? And it just takes one little push of that first one, which for us could be earnings growth declining, and everything starts to fall. So consumption, labor market. Our third concern for our cautious view is valuations. Look at this chart. Look at the right-hand side. These valuation metrics are in the very highest percentiles historically. We were at 24 times the other day on the equity market, on the S&P. That makes me a little nervous having them that high. So this is telling us that stocks are expensive. This is kind of just the same information but put in kind of a color chart. You know, we're all over here in the red, and it makes us nervous. Now, the market is making all-time highs, and there are some tailwinds, and we think a lot of it came from the expectation of what we would get out of the big, beautiful bill, right? The triple B. Stocks rebounded as some of the concerns on those downside risks started to abate when tariff policies got pushed out a little bit longer, when there was the belief that deficits would start to come down with money from tariffs coming in, as interest rates didn't spike back up to 5% on the 10-year. As those concerns started to abate, then it allowed these elements on the positive side to really start to take hold and push the market higher. We would have the tax cuts extended, deregulation. We know that we would get CapEx coming in because of the expensing component of that, and I think that's going to be a huge element for us. We'll be listening to earnings calls this quarter, this earnings season, to see if we hear that. That leads to productivity. So there's lots of things there, but we're just not out of the woods, right? The federal budget does remain out of control, and if it is not addressed sufficiently, the bond market is going to respond. Here we have the dark line is the 3-month T-bill, the light blue line is your 2-year, and the green line is your 10-year. Look at how the 2 and 10-year have consolidated as of late. They're really kind of range bound, and I think it's because you've got bond investors waiting on the sidelines to get a clearer picture, like really waiting for that crystal ball to clear up a little bit to see where we're headed before they make interest rate bets or duration bets for their portfolios. And we just don't have the clarity. It's all these things we've talked about for the last 15 minutes are driving the confusion around rates, and we need to get some more clarity there. If we don't address some of these things, the bond vigilantes that are waiting in the wings will make themselves heard. They will come out, they will start to sell, and we will see yields move higher. So we have to watch and see if that happens. But the equity market doesn't seem concerned, and neither does the corporate market. Look at corporate spreads. Did they widen out after Liberation Day? Yes, they widened out. But investment grade has already come back. Even high yield has almost retraced the widening that they had after Liberation Day. So even the corporate market right now is saying, we think we're going to be okay. So we've only got like 3-4 minutes left, so we're going to go through this pretty quickly. What are some of the conclusions that we have from all of this coming together? Well, we do think uncertainty is going to continue and that it will hurt risk assets going forward if we don't get some additional clarity. Recession risks have receded. Inflation is coming down. We're not going to hit 2% this year, but it is coming down. Earnings, we think, will start to fall a little bit short of expectations, except you know how companies do. They lower them so far, right, that they can beat them, but lower than where expectations were at the beginning of the year. We do expect high volatility to continue. And so how does this translate into your portfolio? This is what we're doing at Crossmark. So we expect choppier markets. So what do we want to do? We want to embrace some volatility. There's different kinds of strategies you can do to embrace volatility, some alternatives. We talked about it last night on our panel. Covered call strategies was one of the ones that I talked about. We think you should expect lower returns. Show of hands real quick. Anyone expect another 20+ return this year on the equity market? It'd be the third year in a row. 1, 2, 3, 4, 5? A few people do. We think you should expect a little bit of a lower return. And so for that, that's some of the things where then you can put your money to work in fixed income, or you can look at maybe some dividend plays to bring additional income into your portfolio to help with returns. We want you to focus on earnings growth and free cash flow. Don't look at PEs, right? PEs are kind of just off on their own right now. I think they're way too high. We want to look at companies that have that earnings growth and cash flow. You want to diversify across different asset sets, so you can look at something maybe a little bit global. We focus on high quality value and less expensive growth. There are tech names out there that you can buy that are not at extremely high growth valuations. You consider something like an absolute return strategy, something where you're just kind of beating cash for a certain component of your portfolio to help buffer the volatility and the rest of it. And the most important element here, our very last one, step up to significant weakness. Have a little bit on the side that when you see the weakness in the markets, especially in those names that do have the good cash flows and the strong earnings, you can step in and buy those names and be ready to build your portfolio. So with that, right on time, woo, awesome. We're going to switch it over to Q&A.
You just said step up to significant weakness. Define significant for me.
Well, significant is going to depend on your risk tolerance for one thing, right? If you're willing to wait and let the market fall, let's say another 7 to 10%, and then go in and buy some names, great. Some people may say, you know, if the market came down 5%, especially if you think the market's going to be up 20% this year, the market falls off 5%, then go ahead and buy some names. You can go in there and put some to work. When I say significant weakness, I'm thinking more 7 to 10% to go ahead and step in. But again, you're not going to do everything at once, right? It's going to be dipping your toe and doing little bits and pieces in there, kind of dollar cost averaging on some of those stocks.
We have time for another question.
When you talk about the sort of three concerns, valuation, labor market, and consumption, how does because none of us knows what's going to happen, but how does a trade and tariff issue factor into some of those things? Like consumer behavior, meaning inflation, does it cause them to pull back? Labor market, right. Does it hurt? I'm just kind of curious how big of a factor that is. Yeah, so obviously when you look at tariffs, the whole question is it going to feed through to inflation, and that's why everyone was so concerned about the CPI and the PPI numbers today. We'll get PCE numbers coming soon, and that'll give us another feed too. But if we see prices continue to go higher and corporations pass that through to consumers, you're going to see tariffs actually become disinflationary because consumers will pull back and not spend. We already had Walmart and Target say, prices are going higher over the next 3 to 6 months. Get ready, we're passing some of this through because remember, it's the goods area where we're seeing prices go higher. So it's going to affect consumers coming through. That's obviously going to affect labor market because as companies, if their margins get compressed, the first thing they do 6 to 9 months out when they start to say what can we do to help our margins is to start laying off people. So that's how it flows through to some of those elements. Not something we want to see. Hopefully it doesn't come to that, but something we'll be watching quite closely. Thank you.
All right.
That's all right.
Thank you, everyone. I appreciate it, and I'll be around if you have any other questions.
You saw it. We got you uploaded, right?